Ross is the lead at UFP Ventures, and he's also a mentor this year at Formwork Labs. And Ross, you've said before that CVCs or corporate venture capital funds get a lot wrong. So I wanted to understand, what is the core of that criticism? Is it structural? Is it cultural, or something else?
Let me first say this comes from based on what I've learned and seen, and certainly there are different approaches to this, and I hope this just opens the conversation as opposed to me having any sort of definitive answers on it. But I think the first foundational issue is that too often corporate VCs don't base their how they build their program on what has worked for 50 or 60 years, which is institutional VC. It's a fine-tuned machine way back to your Kleiner Perkins and Sequoias through today that have proven that, hey, this is how you run a program. And so that's really where we started in saying, how do you run an institutional VC and then adapt it to corporate? I think that's the first piece of it. And little pieces of that are hiring the right people. I think too often hiring internal is the emphasis or the first kind of go at it. They have the wrong compensation models. That's a big one that we could probably spend some time on. That's very difficult for many corporates to manage. And as you might imagine, big corporates, too many internal controls. And there's too many blended roles as well within these teams. Like, hey, today you're strategic or strategy, tomorrow you're M&A, and then the next day you're ventures. They're different sports to play, so it's really hard to have those people do different things. And then I've got a long list of others as well, from the strategic focus the fund has, how they act as preferred shareholders, trying to do too much at once. I think there's too many programs that are, hey, we do direct investing, we do LP investing, we have an accelerator, we also do venture building. Not that you can't do those things eventually, but doing it all at once can be a killer for a fund. There's a conversation around stage focus. Where should a corporate meaningfully be engaged? VC returns,
I
all
think
those things.
like one of the most interesting framings here is like, okay, like let's build it like an institutional VC, but a corporate obviously has some pretty clear kind of differentiators, which is they have this strategic value element. So I guess what is that key differentiator that quite clearly changes the lens that you have to have, and then I think downstream of that it almost affects everything else. Is that correct, or is that yeah?
What's the key differentiator for how you're strategic?
Yeah, well, the reason why I say that is, you want to model on an institutional VC fund, but they are pushing from a financial imperative. But
Yeah.
with corporate, I guess one of the key differences, or what I've seen, is like it seems to be more that there needs to be strategic ROI that's provided.
Yeah.
And then that kind of downstream affects everything else that you're trying to build, whether from
Yeah.
compensation plans to that. So I guess, how do you frame that? And are there different models that you've seen work better, or
Yeah.
work not as good?
Not my line, but I've heard other people say this, but losing money is never strategic. That's where you start first. And with
Yeah.
a CVC, whether they say that initially or not, that they don't care about returns, eventually your CFO, your CEO, your investment committee will. And so you
Mm.
need to care about that from the very beginning. But how do you define the strategic value? I think it's really unique to every corporate. So I don't want to say this is a one size fits all. This is just the way UFP thinks of it. We think of it in there has to be some line of sight towards that startup potentially adding value either at the top line or the bottom line. And that is a lofty expectation. That top line can be either a commercial partnership, seeing some sort of line of sight. So that doesn't have to be tomorrow. It doesn't have to be contingent upon the deal. Maybe some years in the future, hey, we could see where something could work. Or an M&A. I'm not naive to think that a big number of our investments are going to be M&A, but I would be ecstatic if one out of the 20 that we ended up buying. I think that'd be a huge success for our program. And then there's also the opportunity to find margin improvement. Those are a little more difficult to justify, at least for us, because there's not that a potential option. And then like, why don't I just become a customer? There's really not a ton of value to being a preferred shareholder in this, but that's how we define it. And that's a constant reminder and a conversation we have with our investment committee.
Yeah, and I guess like pulling Alice into the conversation as well, like what is that differentiator between someone being an LP on brick and mortar and gaining ideally, financial return and strategic value with the opportunity to co-invest with you versus, hey, it makes sense to do what Ross is doing and we should stand up our own venture fund?
Tough question, because we've probably seen a wide range, right? So when Brick and Mortar raised their first fund back in like 2017, I think that was about the time when we were starting to see new entrants of CVC kind of focusing on the construction space as well. And at that time, we actually saw a couple of different flavors, right? We were working with some companies directly with the M&A team. So like on the corp dev side, for them, like they didn't want to build out a CVC program. And I think a lot of this just kind of depends on who's in leadership, CEO mandate. Sometimes it's even board mandate, right? Like we've had LPs invest in our fund because there was a board level mandate to do more kind of LP positions. So I don't know if there's like a direct answer as to like why, but I do think that there's pros and cons to, all the different paths, right? Whether it's just having corporate development, become an LP in a fund, or you can also have like not necessarily non-strategic CVC, but if you look at like Intel, right? Intel has had a CVC arm for a long time. And they don't necessarily have to invest in things that are directly impactful to the business. Like there's also these, like they're still branded as whatever parent, like LP company, but not necessarily, investing for that. And they're set up kind of like an institutional venture fund, but just solo LP, right? So that's a different flavor. And then you have the like super strategic ones. And then you have ones where it's like CVC plus innovation. And that's where I think is really interesting in our space because, that's like a lot of these corporates in the construction value chain have started with kind of an innovation group. And then they start getting into the investment side because they don't want to lose the upside of working with a company. I've talked to a couple of GCs that are interested in investing in construction tech startups because they were early customers of PlanGrid or FieldWire. And when those companies exited, those corporates got nothing out of that, even though they basically put that startup on the map. So I think there's a lot of reasons. Back to, I guess, like, for investing in brick and mortar, I think one of the reasons is diversification. So if you look at, any of these CVCs that are very strategic, they will likely invest solely in that particular market segment or that particular part of the supply chain. For us, we invest across everything. So in some sense, you will have a little bit more of a diversified portfolio. And that could mean that your risk is just spread out a bit more versus, if something were to happen if AI replaces all the general contractors, right? Like you will have no more GC construction tech. And in some sense, you would have wanted to diversify.
Yeah, that makes sense. And then I guess like Ross, I'd be curious to hear how you think about it. I don't know if you LP on any funds, but I guess like how do you think about these different diversification strategies?
Yeah, and I'll answer that with a comment on what Alice said around a very narrowly focused CVC and not being very diversified. That I feel like the more narrow you are in terms of your focus in your CVC, the more likely you're going to reach with potential investment opportunities because you're so focused on your specific problems or unmet needs you're trying to find that you might reach on a couple of startups that maybe aren't going to actually succeed because you're so focused on the solution they're providing. Maybe it's the wrong team, wrong time, all those things. But I think that's a very difficult question to consider, as your fund kind of goes through different life cycles as a CVC. The LP versus direct investing, I aspire to one day be an LP in a fund as a CVC. We are not right now. We only do direct investing. I think, I haven't lived this firsthand, but I can see line of sight to it to where if you are doing direct investing, your investment committee doesn't really care about, they care about you, but they don't really care about how you do your sourcing and how you manage your fund. And yes, it would diversify us potentially in terms of return, but then you also run a little bit of political risk. And I hate to use that word, but you're in a corporate environment of political risk of if your direct investing positions are not performing as well as your LP positions, they're going to say, well, why are you even doing direct investing? And vice versa, they're going to say, well, why are you doing LP positions? And so unless those are equal, you run the risk of them saying, why are we doing one or the other? Then them maybe not appreciating that the reason you're able to get access to certain direct investing opportunities is because of your LP position. So even if that thing, performs less than your direct positions, you may have gotten access to those direct deals as a result of that LP position. But we have not yet. I think that's sometime in the near future add to our fund, but right now we're trying to do the first thing right, which is direct investing, to my point earlier of trying to do too much all at once.
Yep. And then I guess just an interesting component is this narrative component that you have of talking to the executives and really explaining what you do and how you're providing value on a consistent basis. Is there a specific messaging that you find works up the chain better or worse, depending on the stakeholder that you're talking to? Because obviously you have the CFO, the CEO, but then there's also other business line groups. Like, what kind of messaging are you giving to each one so that they're either bought in or politically giving you the support required?
Yeah. You hope to build the program, and maybe hope's the wrong word, but you deliberately build the program to have your stakeholders be the people with the longest term responsibilities of your corporate.
Okay.
The closer you get in, the more difficult of a conversation it's going to be. And I would even say your presidents, so to speak, are going to be a little bit too close in terms of their focus on the next maybe 2 to 3 years, as opposed to ventures, which often lives in the 5 to 7 years. So that messaging for me is with the CEO and the CFO, and fortunately for us, also the chair of our board at UFP, who was the CEO who started the program, and there's a succession of him going to the chair of the board and then one of the presidents becoming CEO. But that conversation always just centers on the optionality that you're creating for those business units long term, in the categories I mentioned earlier around top line growth and bottom line growth. And there's only so long you can do that, so many years you can do that before you have to start pointing to some early sprouts of success. That's just human nature. And so that's, part of the pressure you have as a CVC also is to show some of those early returns of, hey, this is where this is headed and this is what it can turn into, to get them excited about that, and especially get them excited in the face of some other companies that are struggling. Because like any race, your failures are going to happen before your successes. Those people running that marathon are going to fall by the side of the road before you see the winners. And you have to kind of divert their eyes from those failures, which are bound to happen, and get them focused on the horizon, it's complex, but that's the goal.
And something interesting that I've learned on the CVC front, like obviously like M&A, great returns is really important and an obvious win of what you do. But on the other side, like venture insights and insights as to where the market is going is incredibly valuable. Do you have some kind of like content or messaging framework internally to make sure that what you are learning as to where the future is going is disseminated really effectively through the business? Because I know like there's certain kind of like the mining CVCs have really structured kind of messaging programs internally.
Yeah. I'd first say that your program should have a firewall between what you're learning about your investments, between them and your companies. But what you're seeing in the broader market certainly isn't sensitive, because you can kind of anonymize and see certain trends as results of that. And yes, we do. That's actually something that we've added into the program. One of our associates, Cody Smith, is leading that for us. We call it a trends analysis. And it's really this idea that ventures, if you have perfect information, if you're able to see every startup out there, you can see the heat map of where founders are solving problems. And you can say, hey, if there are 5 startups in this space, this is a problem or this is an unmet need, Mr. President, and you can point their attention towards that. You can give some idea of what they should do about it based on their business. But really, we want to just spot trends that we're seeing through the ventures lens, because I don't run their business. I don't know everything that they're doing. They've got that perspective, but I'm trying to add information that maybe they don't otherwise have insight into. And so I give them that lens. We give them that lens, give them that trends analysis, and help them be better informed with some of the decisions they're making for their business.
That makes a lot of sense. I guess like pulling back to where we started of, CVC gets a lot wrong. And one of the things that you mentioned was compensation structure in the team. So I guess like, how do you think about that? And also like including Alice in this conversation of, I'm sure you've advised on multiple CVC arrangements and setups for your LPs as well.
Yeah, this is the most complex but the most important part of how your team is structured. And that was something that my predecessor, Adam Goodson, did a very nice job of making very clear from the very beginning, is that the compensation structure has to be right. The incentives have to be right. That's true in venture. That's true in life. That incentives have to be structured correctly to get the right behaviors. And so we have a structured compensation model that mirrors more of a 2 and 20 carry model. Now, that it's not exactly structured the same way a GP type arrangement would be with a traditional fund. So it's got a little bit more of a shadow aspect to it. And I could bore you with all the details of how we go about it, but we've got a long document, a lot of set of slides that solves for unique things like, hey, what if a team member gets promoted internally? How do we manage that? What if one of our portfolio companies we want to purchase, quote unquote, early? Will the ventures team be an inhibitor towards that because they might miss out on some sort of long-term value creation as a result of it being external for a while? So how do you solve for all these unique to CVC problems. We like to think we've got a solve for all those. We're still new in terms of seeing how that all turns out, but we tried to kind of see the future a little bit as far as why do these funds eventually fall apart, and let's build some structure and scaffolding around that to make sure that we don't fall victim to that, or at least we have the best defense possible against it. There's no guarantee of success with any of this.
Yeah, even on the, I guess, institutional VC side, you also still kind of see a range of carry structures. And sometimes it's like you won't get carry until you make this level. Some time, like for some funds, they allow carry for, analyst roles, right? So I think this is like varied across all over. And I agree with Ross where like you definitely have to align incentives, because we have seen situations where, especially if it's strategic investment, right? Like sometimes there's, longstanding relationships where it's like, oh, it'd be really great if you invested in this company due to some longstanding relationship, even if it's not necessarily kind of the best company or, the potential winner in that category, right? So it's like, if you're thinking about things in the near term, right? I think decision making in, 2-year time frame is oftentimes very different from, if I'm in the fund for, 10 years, right? Then you have the incentives to work really closely with those companies, make sure that, they make it big. So yeah, I think like incentive alignment is really hard, especially on the corporate side. Also, I think it's because, maybe it's from balance sheet or, you don't have the right fund structure. It's really hard to do. So actually, Ross, I commend you guys for that. And I know we've chatted about this a little bit before, but there aren't a lot of CVCs who give carry to people who work at the fund or some type of like carry like structure. And with a lot of that, I think, people can just kind of do whatever deals, right? And we've seen people do deals just to do deals with other people to build relationships for personal career growth and things like that, even if it's not kind of, the best valuation or the best kind of long term for the fund itself. And we actually saw a lot of this probably like in the 2021 froth. There were a lot of people more on the institutional VC side where people would do crazy investments. And at that time, there were crazy markups, do investments, get marked up. Who knows? And there were definitely companies where a couple of years down the line, there was a recap or, stuff happened to that company. But, you can make investments purely for jumping to another fund or purely for kind of short-term personal gain to kind of build up your resume and then jump ship to a different place. So there's a lot of, things. Yeah, it's just hard because even if you're incentivized properly, right, there's always going to be people who try to take advantage for whatever reason.
And it's dependent to, I give a lot of credit to UFP Industries, the organization I invest on behalf of. It's kind of a Goldilocks organization in a lot of ways. And one of the ways is the culture in which UFPI pays and compensates its employees, regardless of the ventures. Simply put, it's very much an eat what you kill kind of culture from the sales side. And that lends itself really well to venture, because venture really is, hey, if you found something and it turns into some big upside opportunity for the organization, we're going to reward you for that. We're not going to just homogenize all that. There's a little bit of that certainly within a corporate. That's a fact of life with it. But the culture lended itself really well to the executives at UFP understanding, why we needed this for a successful fund.
Is that talent problem a real challenge for CVCs? I guess if you're not hiring people from the business, they don't have the desire to move up the corporate hierarchy, which then means that they want to pop out to another CVC or they want to pop out to an institutional VC. Like, is that talent problem really challenging?
Yeah, I think it's probably more of a problem in that you're not going to get a lot of serious looks because of the reputation CVC has. I'm confident in the program that we have, that once people understand what it is, they should be excited, if not more excited, for the opportunities that you can have as a principal or an associate on our team versus others. But I've done this now, hiring a couple folks, and it has been a pretty good mix of people out of corporate as well as some institutional VC funds. There's a lot of funds out there and a lot of mid-career talent that are looking for the next step. And if you can get them on the phone and talk to them about it, you can get them to see that this is a pretty good opportunity to build their career.
And I guess I wanted to just pull it back to something you mentioned before this call, which is kind of the strategic challenges around follow-on investment. So if you could just elaborate on that a little bit as well.
Yeah, the basic question you get for a follow-on is, how do I buy more strategic value? I'm already in, so what am I buying? for another check for $1 million or $2 or $3 or whatever it is? And that's a tough question to answer, with a corporate, because you are in. The way we answer it is a couple pieces. One of which is it is a mind share purchase that you're making when you do a follow on. That founding team, that CEO, especially as they grow, and if it's a follow on, obviously they've had some success. They've got new investors, new shareholders on the cap table, somebody new on the board. They have a lot of people to pay attention to, customers, strategic investors. And anytime you put a little bit more dollar in, there's a I don't want to say kind of it's a response appropriate to your commitment to them. They'll be committed to you to work with you. So that's a big piece that we sell to our investment committee. And the other part of it is if you're doing a follow on, more than likely it's one of your winners in your portfolio.
Mm.
And if you have the program built the right way and you're telling them that this is going to be a fund that pays for itself, it's going to be a profitable fund, in addition to all the strategic value I'm providing, this is the ammunition I need in order to keep paying for my fund. This is how it becomes successful and evergreen and continue to create optionality. And so that is just a kind of a required part that's you point to. This is what institutional VC does. You win with the winners. You really express to that investment committee that, hey, this is how the fund lives, becomes durable, is the word I like to think of it for the fund, rather than a kind of a 3 to 5 year life cycle. This is something that goes into the second fund, the 6 to 10, the multiple CEOs, multiple CFOs, where you can really build a reputation for adding value to the organization.
Yeah, and I guess like flipping it around to the startup side, which both of you could definitely speak to really well, is, what should startups be mindful of when they put a CVC or allow CVC investment, whether it's specific rights or even having them on the board as a signal to the market? What are the considerations around that?
Yeah, that's a tough one too, because it's every situation is a little unique. But I'd say what I often tell and startups when they're talking to me and talking to others is one, just ask how the team is compensated. I know that sounds a little bit sharp, but just better understand where their incentives are. I think that's really important. It's not necessarily a deal breaker if they're not incentivized in a way that has a carry model. It's just something important to know. And I also would tell startups, just make sure you are yourself. It's just like kindergarten, it's just like grade school. Don't twist yourself into being something that fits what you think that strategic is looking for, because oftentimes that strategic doesn't even know what it's looking for in kind of an explicit way. So just be yourself when you're talking to these corporates. And then there's a whole bunch around, making sure you're not agreeing to the wrong kind of terms. But I think some of that stuff is self-explanatory and also dependent upon how desperate you might be to raise a fund or raise around.
Yeah, we're definitely seeing, a lot more, I guess, generalist investors and institutional investors be okay with strategic on the cap table. I think there was a time when it was almost like, well, you can't raise from institutional investors, which is why you're raising from strategic, or, there was always this kind of negative connotation to it. But I think it really does depend on like what is that strategic and what is that relationship to the company? Because if it is a strategic investor that has some type of, aligned business interests, then one can see that like, oh, this is a customer or this is someone who is clearly, leveraging that startup to grow, or, it's a new business unit or something like that, right? And that's actually now being reflected as positive in the eyes of institutional and generalist investors, where it's like, okay, well, if you can raise some money from your customers, like they love the product so much that they want to double down on the success of that product. The only thing for us is like, there's previously been this almost like anti-competitive kind of sentiment around who's on your cap table. And this was more with contractors. And these were contractors writing small checks, right? They don't even have a formal CVC, but these may be some customers that wrote a check into a startup. And, sometimes, actually, I think now it's probably coming up more and more often. It's like, oh, well, who are you working with? Who also invested in the company? And if it is a competitor, sometimes competitors are not as inclined to work with a startup. So you also don't want like that strategic investor to really close off a portion of that market for that startup. Obviously, there's a lot of ways that you can kind of explain it. I think like people are more open and willing to listen now. So it's not, a clean and clear, like, oh, if so-and-so's on your cap table, we're not going to invest, right? Even in the latest, even if we look at like DataGrid, like Trimble invested in DataGrid, they ended up getting acquired by Procore, right? In some sense, like people argue and say like Autodesk, Procore, Trimble, one of these big incumbents, they're all kind of quote unquote competing with each other, right? But it's interesting because now we're seeing, multiple of these large software companies on cap tables of some of these startups. And it's definitely interesting when they get acquired by one of them. And it's like, oh, there's like money transferring from Procore to Trimble for this particular company.
Yeah.
I guess on the other side of this, is there something corporates should ask for in their investment that you could provide value? Like I've heard of contractors like investing and then being like, hey, if you ever offer better pricing terms to a specific customer, we get that specific price.
Yeah.
I've seen like a lot of people say that.
Yeah, it goes back to how is that team incentivized, as an investor. If they're not incentivized for the maximum value exit for that startups, then they'll ask for things like that. And you can't. I know that, and I don't think that I don't think that provides the value that they often think it does. We find it to be, it's kind of a handshake thing to where you want to be such a good shareholder and such a good investor that they want to work with you. They want to give you the first look at something. They want to maybe give you some unique pricing because you're such a good partner. But anytime you start putting those things in writing, not only does it change the relationship, but investors like brick and mortar are going to look at that as a big turnoff when it comes to their follow-on.
Do you have anything to add to that, Alice? Or?
No, I think that's the main thing is like, just don't put weird terms, no right of first refusal, no any of that. I mean, the best relationships have basically been instances where it's like, okay, well, you've signed your initial enterprise deal or something like that, right? And you're looking for a long-term, as a customer side, they're looking for a long-term relationship with that startup. And in some sense, if you do the math, it's like me as a customer, if I put $1 million into this company, it's actually generating $10 million in value. Me being a customer, and if I can invest right before I sign that deal, there's something that you could play with as a customer investor that, could be beneficial. And I think, a lot of people are getting more educated about this, right? Where it's like, I know the quote unquote value that I can add to this startup as a customer. Why don't I also take advantage of that from an investment perspective too? So in those cases, it's like, okay, well, I know that, even if I spend, a couple $1,000,000 with the startup, it is adding that much perceived value, right? Just in terms of valuation and all that.
Yeah. As in you're going to make more money by being an investor than you are from the discount, essentially. Something I actually had like Ross, which I'd be really curious to hear for your insights, which is for your deal sourcing. Obviously, you have connections across the business because people in the business are trialing new tools, finding new tools and finding things. Do you have any either sophisticated or structured way of collecting those insights of this is a new tool being piloted in a particular location? Because so often corporates are testing these tools across their companies and they have zero idea of, what's going on.
Yeah, it's really relationships based. I wouldn't say it's structural. Maybe that's a flaw of our program. I wouldn't say it is, but maybe it is. We make sure that, that takes some time too, especially going back to hiring externals to an organization. I was new to UFP 3 years ago. The team that we've hired, save for one, actually, that's another kind of key insight is I think it's always good to have one insider on your team that you hire from within to be able to maybe make some of those connections to talk to the right people. But we get inbounds all the time, and it's increasingly happening because of those relationships we're building within the business, within the different functions, because we do give them the attention and take a look at it, talk to them about it. And it's a huge advantage for us to be able to have effectively it's almost like a research group that is actively looking at things from a customer standpoint and then throwing it over the wall literally to us. Say, hey, take a look at this. We're looking at it. And we're like, oh, that's interesting. We'll take a look at that too. So I wouldn't say structural. It's just having the right relationships throughout the business and knowing that, hey, we should be top of mind for them whenever they talk to an early stage company. And sometimes those are duds, which is perfectly fine. And sometimes they're great opportunities. Keep them coming.
Yeah. Alice, have you seen anything, I guess, beyond relationship driven?
I know that like some contractors have done like internal innovation, not necessarily like contests or competitions, but they may use like, I think it's Idea Bright or something like that. So there are some software tools to be able to do it, but I do think still at the end of the day, it is relationship driven. And also like there is a cultural aspect to it where you do have to like empower the people in the field or empower the people who are actually like in the front line to kind of test out, try out new tech, and then also like, encourage them and also incentivize them to share it with corporate and then share it across the industry or across the company. Um, and I think like I've seen people do that in ways of just like, it doesn't necessarily always have to be like monetary, right? It could be, access to the president of the company or something like that, right? Where like, if you've got a great idea or you've done a really good job at implementing something, like it could be just recognition. And I do think a lot of that goes a long way with just building a culture of um, trying things out and sharing it across an organization.
Yeah, and showcasing that innovation is important and a priority for the business. I guess like finishing it up over here now, Russ, do you have any, I guess, like final quips or final statements and what you think that we haven't touched on that CVCs get wrong that you believe is important to be aware of?
Good question here and some of my points. I think maybe one thing I haven't talked about as a quick final step here is you have to understand who you're investing on behalf of as a corporate. And I'd say more often than not, you're dealing with an organization that has a attention span it's not 7 to 10 years, I guess. I think it's maybe to be more direct with it. It's very difficult, in my opinion, for a corporate to be a pre-seed and seed stage investor. I think that is a recipe for eventual failure of a CVC. We have a more strict Series A focus, which it can vary a little bit based on opportunities. But really that Series A allows you to have more of kind of a 3 to 7 year horizon, which manages turnovers or manages transitions for your leadership team for different CEOs. It also helps to make sure that you're investing in companies and not creating any sort of like encumbrance or pressure on an early stage company not to pivot. Because strategic have a certain rationale for investing, and if you invest too early and they need to pivot, all of a sudden it's like, this is a weird fit now because you're pivoting into a different industry or a different product that maybe we're not as interested in. So that's a piece of it. Great insight for you, but it's something I haven't talked about.
Yeah, no, it makes a lot of sense. I mean, Series A, you've got some like level of product market fit and some kind of structure and potential for use in the business. Do you have anything to add there as well?
No, I mean, I think that's a really good point because we've definitely seen changes in CVCs depending on outside factors, share prices, CEO transitions, right? Like it's usually some initiative of some executive. And if they end up changing roles or whatever, right, it's really sad to see that those CVC groups end up shifting what they're doing or even fully dissolving. We've seen a good number of CVCs actually dissolve, I think, in the last like 2 years. This is not just construction. I'm looking at outside of construction. But then again, there's actually a good number of funds that have shut down in the last couple of years.
True. Yeah. And maybe a couple more points I'd say, and work these in however you want, but I think too often corporates are asking what startups could do for them as opposed to asking what they can do for the startup, to kind of channel my inner JFK there. I think that's an important piece. Like you're a preferred shareholder, act like it. And the other piece is no matter if you're a lead or not, and I think it's okay for strategics to lead. And there's complexities to that, but it's okay to lead. But even if you're not leading, underwrite the deal. Know how to underwrite the deal. You should never do a deal and not do your own underwriting to say whether or not this is something that fits your targeted returns, because then you're going to start falling into that category of being a kind of a dumb strategic that'll follow whatever. And that's a reputation that I don't want for my fund, nor do I want to have to deal with that reputation in the industry because others are doing it. So underwrite every deal.
I feel like that's also feedback for not just corporates, but also institutional investors. We've got a huge follower mentality here in Silicon Valley.
Wait, Alice, also as a final question, is it bad or what is your opinion on a strategic leading around?
I think if they know how to underwrite and they can articulate why they're underwriting it this way, it makes sense, right? And I think that's usually what we're looking at is like, we've seen strategics either underprice or drastically overprice. And I think the scarier thing is actually drastically overpricing a company just because, if you look at just the venture dynamics, they're going to have to raise another round in, 12 to 18 months. Are they going to be able to grow into that valuation? Or do they actually need this much capital? Like, I think there is this, I don't know if it's emotional, but like, this additional connection sometimes with the strategic investors where it's like, this is like God's gift to earth. And like, I think it deserves XYZ, right? So I think if a strategic investor is leading a deal underwriting it and the valuation makes sense and there's no kind of tricky terms or anything like that, I think it's perfectly fine. What I will say is, as long as, there's other investors kind of also coming in at that round so that you're really balancing the value that each investor is bringing. And this is what we say to like almost every startup that we talk to is, a lot of them come to us and they're like, oh, we want a sector focused fund, in this round, right? And it's like, okay, well, let's take a step back and hey, entrepreneur, like, tell me what you need help with for the next 12 to 18 months, right? And if it's like, oh, we're really interested in like, and actually a great example would be like a robotics company, right? If they're at the early stage and they're like, well, we actually need a lot of help with, rapid prototyping, sourcing of, parts, blah, 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 blah. Maybe they already have their first pilot customer or their prototype test bed, right? It's like, okay, well, are we actually the best like lead investor at this round, right? Like we could definitely help with a lot of industry knowledge, industry intros, but if most of your need is actually going to be on the robotics or deep tech or, crazy AI side, like that's not something that we have a lot of expertise to help out with. So I think like there's almost some sense of thinking about the round and building it out with the experts or, the people that you want around you to help you with that round and then, what your next milestones are. So I would say like there's definitely better stages for when a strategic or a sector focused fund or a marketplace fund or a, pure B2B SaaS fund or even like, a crazy crossover fund that could stroke a $50 million check, right? I think there's, certain stages of a company that, those types of investors make sense. And it's really, helping the entrepreneur understand like how they're thinking about that. And in some instances, maybe even like, providing some education around that.
Well, thank you, Ross, for coming on the Startup Scaffold and chatting to us. And, we've had some great feedback of having you as part of our program and being a mentor as the program. So thank you so much for doing that. And yeah, if you wanted to reach out to Ross, do you have any way they can reach out to you or any links you want to plug?
Yeah, I'd love to, if you've got either a current CVC, future CVC, past CVC, I love talking to folks that have lived it, just to share notes, and I can be more of an open book even with some of the deeper details of how we operate a fund, because other CVCs being successful helps our fund be successful from a reputational standpoint. But yeah, reach out, LinkedIn, email. You can put in the notes for my email if you'd like. But and then from a startup perspective, happy to add more perspective for you on some of those do's and don'ts when you're talking to these strategics out there in the wild.
Awesome. Well, yeah, thank you so much for coming on, Ross.
Thanks, Ross.
Thank you both.